Welcome, everybody. I love the music. This is Jake Bernstein. We're talking about navigating seasonal cycles. I appreciate the opportunity to present some of my work to you. It's been a long time coming. I've been doing this for 52 years, and I'm probably beginning to sound like it too. Don't be fooled by the picture. Next week, I'll be showing the real me as opposed to the high school me. We're going to be talking about seasonality in its various aspects and how it can be used either academically, in other words, the pursuit of science, and or financially as a trader. So sometimes I'll be academic, sometimes I'll be trading based, but in any event, this is a great opportunity for you to learn from me. I want to say from the beginning, number one, no one is paying me to be here today. I'm not paying anyone to let me be here today. This is purely educational, and everything we're showing is hypothetical and designed exclusively for educational purposes. I want to thank the foundation and all the great work they do. Fabulous opportunity for people to learn how these things really work. So I'm going to start at the beginning. We're going to cover a wide variety of subjects, and if the foundation will let me come back again next week, I'll do this as long as they want me to, and as long as we're getting good feedback. And feedback is very important. I want to know how I'm doing. In other words, am I addressing my comments to things that concern you, that will help you? Because the most important thing is for me to help you, for me to share my many years of accumulated knowledge with you, and do it so specifically and clearly so as to be an asset to the foundation in its great work. So I'm going to start at the beginning, and by the way, let me get my pointer. I'm using a new pointing tool, which may or may not be very effective, but I'm going to try and do it right. So just bear with me. I want to prove that you can teach an old dog new tricks. So we're going to cover a variety of subjects. First, we're going to talk about why do we want to study seasonals. Seasonals are an incredible asset, a totally incredible tool, because not only can they be demonstrated statistically and specifically, but they allow research to be done as opposed to what is common in so many other platforms and methods. In other words, you have to expect that something will happen. You have to take it on faith. With seasonals and cycles, nothing is taken on faith. It's either there or it's not there, and that's super important. We're going to talk about some definitions, concepts, pragmatics. We're going to talk about the long-term incredible accuracy of seasonality and cycles. Who uses cycles? The types of cycles that are available. We're going to talk about seasonal charts and seasonal dates. All of these things very specific. Nothing to be left to your imagination. We're going to find some examples of seasonals. I'm going to show you some really incredible things today that I hope you'll find useful in your trading. My goal, number one, to give back to the community. Number two, to teach you things that will help you. Now, speaking of things that will help you, I want to stress, I will not be talking about fundamentals. I'll be talking about the technical aspect of cycles, not what causes them, not what happens with international geopolitical events, and what impact they may have, because I have found, as Edward R. Dewey said, cycles are the mysterious forces that trigger events. Something happens, you then go and look at the cycles and you say, wow, that is pretty amazing. This was new. This was bound to happen. It's new information to most people, but look how the cycle lines up with the reality of things. Very, very important. So we're going to go to the next slide. And by the way, I'm happy to provide the slideshow for everyone. And do keep coming back here and let me know what you're thinking. That's super important. So let's go forward. And by the way, I want this to be both academic as well as functional and practical. I want you to understand the beauty of seasonality and how seasonality and cycles are the same and how they're different. So as I said before, the main reason for me being here is to share with you knowledge that I've accumulated over the years to help you become a better trader or a better investor or a better academic, however you want to approach cycles. To that, I owe the Foundation for the Study of Cycles. Thanks for being a great institution for education and helping traders learn how to become better traders and helping researchers how to understand cycles and their power. So cycles are a very powerful tool, which I didn't discover until I read the work of Edward R. Dewey. It was quite an accident for me because I was in the library. It was 1967, was my third year of college, and I had just learned trading, or at least I thought I had learned trading. I desperately looked for answers, found nothing except opinions, interpretation, and so forth until I saw the work of Dewey. I'm holding in my hand a magazine entitled Cycles, Official Bulletin of the Foundation for the Study of Cycles, February 1973. I looked through the magazine and saw things that I was not interested in, like cycles in post office revenues, cycles in population. But then, looking through some of the other editions, I saw things that really interested me. For example, cycles in the stock market, cycles in seasonals, the 5.5-year cycle in corn and wheat. And that was my great discovery. From that point forward, my interest in cycles grew dramatically until it is what it is today, which is very dynamic understanding of how cycles are specific and clear in their work. I want to differentiate between what I do as a seasonal cycle and what is commonly understood as cycles. Cycles are repetitive patterns. And by the way, I want to thank the directors of the foundation for giving me the opportunity to be here. And if they let me be here, that would be a great thing, because I think I have a lot to teach you despite my voice, which is failing rapidly but will be reinstated because I'm getting some great new surgery. So, a bit about me. I'm a real trader. I've been trading since 1967. My methods are strictly operational, algorithmic, no opinions, no interpretation whatsoever, and that's where the cycles come into play, because cycles tell me what has happened and also give me an opportunity to project what will happen, not with 100% accuracy, but certainly with great accuracy compared to most other methodologies. So I'm going to share a lot of my knowledge with you and hope that you can put it to work to help you become a better trader, make more money, and of course, to enjoy the beauty of cycles and how their ability to predict things that are going to happen with great accuracy, not perfect, you understand, but with great accuracy. I'm going to show you my methods, which I've shared with people through the world and through numerous books that I've written. So, what about me? I've traveled throughout the world. I've taught people everywhere how to trade, including major exchanges all over the world. I've been on CNBC, Wall Street Week. I've had 45 books published, so I'm a little bit aware of trading. So, my epiphany came when I realized that cycles have the ability to let you know that something is going to happen at a certain point in time, and that if we take that cyclical pattern as a setup, as a pattern, we use that pattern with timing, we can get very close to when actual events will happen. We can't tell you why, or as Dewey said, cycles are the mysterious forces that trigger events. So we're going to differentiate between cycles that people normally look at and what is a seasonal cycle. I'm going to show you some ideas and share them with you. In fact, let me cover the good news, bad news aspect. The good news is there are literally thousands of patterns that repeat. The bad news, there are literally thousands of patterns that repeat. You need to be able to differentiate those patterns which have predictive validity and those patterns that don't. The sad news is that most patterns have no predictive validity. They look good on paper. It's like a lot of things in life. But in reality, when you try to use them, they don't work and they predict nothing. So what we want are patterns that have predictive validity. We know that cycles have predictive validity because there are numbers and they can be researched. And of course, the foundation has some great tools for doing that. My approach to finding cycles is very simple. The reason I do that simply is because I'm not a mathematician. I'm simply a visual guy who likes numbers and likes to put together patterns with numbers. Let me give you an example of what I mean. Oh, by the way, just to be specific with you, in this day and age of distance and social interaction through the internet, sometimes you don't know where people are. This is where I am right now, the Pacific coast of California. In fact, right over here, inside the redwood forest. So let's get away from all that. The evidence about seasonality and cycles is absolutely undeniable. You can't change history. You can't change the numbers. And when you compare seasonality and cycles to what we know about other methods and systems, that require interpretation, cycles win every time. Let me give you an example. We're going to teach you clarity, objectivity, proof of concept, proof of procedures, potential outcomes of cycles, types of seasonals, investor trader applications, profit maximizing strategies, and more. Cannot teach that all to you in one session, but please keep coming back. You won't be disappointed, I assure you. And best of all, it won't cost you anything. So let's take a look. Here is a long-term cycle. As you can see from the bottom scale, 1998, 1989, 88, 90, 91, 92, 93, and so forth. And you can see that the cycle is not perfect. Sometimes it peaks early, sometimes it bottoms late, sometimes it bottoms exactly on time. But we're dealing with an imperfect concept. But we can take that concept and use it in a model. The model that I use is setup, trigger, and follow through, with which many of you are familiar. I'm looking for a pattern that has predictive validity. I take timing, and when we come into the window of opportunity where the cyclical pattern is expected to turn, we begin to look for timing that will confirm the cycle has indeed turned. So, if we're looking at the cycle over here in cotton, for example, just let me move one thing out of my way here. We can see that right now, as we speak, the cycle has projected a low in cotton prices. That does not mean I'm going to run out and buy cotton futures or a cotton-related ETF, but it does mean that it will take the opportunity to look at some timing triggers, which will give me an opportunity to say, yes, the cycle has bottomed, or no, it hasn't. So, for example, if we look at the chart right over here, we go back in time, we will find that many of the traditional timing indicators, moving average channel, expansion, contraction, divergence, stochastics, so forth, will also turn at about that time. So we have timing and cycles together. As you can also see, the cyclical peaks are less predictable than the cyclical bottoms. Why? Because when prices bottom, they can only go so low. But in terms of the upside, there's no limit to how high prices can go. Let's look at another one. This is the cycle in US dollar versus Japanese yen. Those of you who have read my last two articles in the Foundation publication, the newsletter, will see that we correctly predicted a bottom in the yen dollar, and that since that prediction has been made, the yen has moved very strongly up against the US dollar. And you'll also notice a near perfect cycle right over here. We can measure the cycle and we can determine approximately when it's going to bottom. So we had expected a low right over here. That low did not develop on timing until just recently, which is what I wrote about in the article. So that is an example of a long-term cycle. The Foundation, by the way, has some phenomenal tools for finding these cycles, and kudos to Dr. Smith and Lars von Tienen for their excellent work in doing those presentations, because they know how to use that cycle finder tool incredibly well. I don't. So I'm just a nuts and bolts guy that likes to look at pictures and find the cycles visually. Let's look at another chart. The combination of cycles. The British pound, approximate 7 to 8 year cycle. Again, you can see it's not perfect, but it's very predictable. And what's better even then is we can take this big cycle and divide it into 3 or 4 smaller cycles or harmonics and get smaller bottoms and smaller tops. So this would be for a shorter term use spread over here, the orange one. The green or the blue one would be used for longer term moves. And you can see what's happening. Right over here in 2024, about now, on into the beginning of 2025, both of these cycles bottom. What does that mean? It's a confluence of cycles, and it means that most likely there will be a very strong, concerted move in the British pound futures against the US dollar. No guarantees, but the next step is what we're waiting for, which is timing. So we have two elements of my model: setup, trigger. The trigger is timing, and that is followed by the third step, which is follow through. very important aspect of the model. And that model has made me a lot of money. And I tell you, quite seriously, the cycles have made a big difference in my life all the way around. In fact, the cycles have allowed me to make money on every piece of real estate that I've ever owned because of the long-term cycle in real estate in the United States, which is 17 to 18 years. Some people say 19 years. So let's go forward. The difference. Oh, one more. Here is a very interesting cycle in the T-note, the 2-year T-note futures. I want you to look at this seriously. Notice how beautifully predictable these bottoms have been. Not exact, but very predictable. And how long is the cycle? Very, very easy to look at. 1, 2, 3, 4, 5, and approximately maybe 5.25, 5.5 years. And we can measure those cycles. I say to you, if the Federal Reserve replaced all of their economists with this one chart, they would not only be more accurate in their forecasts, they would save a lot of money too, reducing the budget deficit. So, I think I have one more cycle to share with you, and that would be right over here. Soybeans. Again, the longer term cycle in bluish green, and the shorter term cycle within that cycle in orange. So we've got two cycles combined. What does the cycle pattern say right now? It says that sometime in late 2024 to early 2025, there will be a confluence. Both cycles are expected to bottom, which would be very dramatic and very accurate when combined with timing. And I want to stress, combined with timing, super important. Next slide. So, the definition of seasonality, and remember, we're going to focus not on the long-term cycles, but in this report, only the shorter-term cycles, which are seasonals. To be specific, and you can read while I'm talking. To be specific, cycles within the course of 1 year, in other words, within the calendar year, are referred to as seasonal cycles, according to my definition. So if you have the calendar year, and you divide the calendar year, of course, into days and months, any pattern that repeats within that year is a seasonal cycle. I find those much easier to deal with, and I don't have the time to wait years and years for cycles to turn. Of course, I will look and see if there's any significant ones turning now in the long term, but seasonal cycles are very predictable, easily testable, and give you the advantage of being able to execute those cycles in a shorter term and make your money work better for you because it's constantly working on shorter term cycles. In addition to that, there are some shorter term cycles that occur within the year, seasonal cycles, that have been around since the late 1800s with high probability of success. No guarantees. Let me show you what I mean. Let's go to the next slide. Example. If I took all of the contracts of May heating oil futures from 1980 until now, I could draw a chart by computer that shows the tendency of this heating oil futures contract on a yearly basis. In other words, what I've done is this. By computer, mathematically, we've taken the highest price of every May contract every year and made it 100. We've taken the lowest price and made it 0. Process called normalization, and that's about as sophisticated mathematically as we're going to get. The computer made one chart that shows the seasonal tendency, and it's not rocket science. If you look at my red arrow, it's pointing to a level on the chart in March and April, which has a green arrow up every week since the second week of March. Underneath the arrow is a number. Percentage of time the price is higher in green or lower in red compared to the previous week. So example, if we go to the first 2 weeks of February, the seasonal during this period of time is lower over 60% of the time. If we go to this seasonal over here in March, you can see that the seasonal, according to the computer, has been up over 65%, 62% of the time, week after week. So in terms of bringing this down to a trading decision, It's an easy call for me. As I said before, it's not rocket science. It says you can expect, if history repeats, that the price of heating oil futures May contract will go up beginning the second week of March, ending the third week of April. Very simple. So we are just now completing step one. In other words, this is a seasonal setup. It tells us what the market has usually done. We do not expect this to repeat every year, but in order to improve our accuracy, we go to the next step, which is a timing trigger. I will not be teaching timing triggers in these sessions until maybe we've had 5 or 6 of them, if they'll let me to continue. And I'll show you how we combine this with timing in order to improve the accuracy of the cycle. Let's go to another one. And by the way, if you do have questions, don't hesitate to write me. My email address appears at the end of the presentation. What I'd like you to do in what I'm showing you here is to compare what we do with seasonality with what's available to traders using other methods. Example, chart patterns, retracements, Elliott wave, Fibonacci, breakouts, support, resistance, artificial intelligence, correlations, earnings, fundamentals, cycles, even astrology. These are all examples of patterns. Some patterns, such as the golden cross and the death cross, are based on an interpretation. They say to you, if the 50-day moving average goes above the 200-day moving average, we're in buy mode and it's a bullish cross. In other words, a golden cross. The golden cross strongly suggests that prices will move higher. If the 50-day goes below the 200, we have the so-called death cross, meaning prices will go lower. If you take those two concepts, you put them on the computer and backtest them, you will find they don't work. They may make money in the long run, but in the short run, they have so many consecutive losses that you will run out of money by the time they start working. So we don't use those concepts in seasonality. We only use what we can see and what we can test. So let's look at another slide. The Dow Jones normalized price from 1901 to 2017. So we're talking about a substantial number of years here. And this is what the seasonal pattern looks like. It's not perfect, but it shows that stocks usually begin the year on a low point. They move higher. They tend to go down from August into September, October, and then they have the so-called year-end rally. I've only run this chart through 2017 because I want to show you what the chart looks like after that. So here is the chart. The Dow Jones, 1920 to 2018, and you can see, quickly comparing the two, with just a visual, you can see they're generally similar. Now, you might ask the question, Jake, are you trying to tell me that we've been in a bull market and that the chart has looked like this every year? The answer is no. I'm telling you that this has been the normal seasonal tendency and that the magnitude of the move has been taken out by using a normalized chart. But most important, this chart also tells me when prices have been predictably strong and when prices have been predictably weak. The reason you don't see any predictably weak moves here on the chart is because the stock market has been in a secular bull market, meaning ultra long-term bull market, since 1920 and before. So, as I said before, it's not rocket science to see that this is the strongest part of the year. Right over here, we tend to bottom out in late September. September tends to be an unpredictable month, which is beginning to be that way. And then we begin and resume our uptrend in early October for the year-end rally. We also know that the 3 most predictably bullish months of the year are weeks of the year are week number 1, 2, and 3 in April, something that people would not ordinarily expect because they're thinking prices must go down because of taxes. Not the case. Now notice, this chart only runs to 2018. Let's go and update the chart. The next slide showing 1901 to 2024. Now I ask you, who in this business is willing to show a track record that covers so many years, 123 years to be specific? We can ferret out the strong weeks from the weak or the unpredictable weeks. We can see the year-end rally. This is very specific and very useful to traders because you know the seasonal and you know what to expect. Can a trader do seasonal trading by itself without anything else? Absolutely, because it is a standalone method when combined with the trading model that I've told you: setup, trigger, and follow through. Let's go to another chart, and if I'm going too fast for you, no problem. Just hit the replay button and start again. I do have a lot of information to share with you because, sincerely, I want to give back to the business that has done so well for me. And unfortunately, I see so many struggling traders out there who just can't make money no matter what they do. Why? Not only because they don't have the discipline, but because they don't have the methodology. If you combine a profitable, testable, predictable methodology with timing that's effective, you have the best of all possible worlds. It gives you the confidence you need to create the discipline that you need to create the profits that you need, which in turn will create more discipline and confidence. So let's look at this chart. I ferreted out just 1910 to 1970, a 60-year period, and look at the comparison. You can see very similar trends. You can see very similar numbers toward the end of the year, and so forth. So this is the kind of consistency I'm talking about. But guess what, folks? You ain't seen nothing yet. Let's go to the next one. Here I took the seasonal composite and H&R Block. Why did I pick H&R Block? H&R Block is not a tech stock, not primarily. It's just a simple old, boring accounting stock. They do taxes. Looking at the chart, and I'm asking the question, is there anything on this chart, based on what I just explained to you in non-technical terms, is there anything on this chart that gives me an idea of whether I should buy this stock or sell this stock, and if so, where and when? Let me show you. My eyes are immediately drawn to this right over here, which shows 3 successive weeks up, and they plot in the up direction. So you have prices going up with high probability, beginning the second or third week in May, continuing until the first week of June. I also see this one right over here, 3 weeks up in August, and I see some random scattered weeks up and down here. But what I'm interested in is the combination of percentage of time up, designated by a green arrow, and the direction of the move, designated by the green line. I want to see both of them together. Now what I can do is really quite amazing. I can reduce this by one more level. In other words, I can do something most people can't. I can go to the exact data history and ask the question, what is the exact day to get into this trade? What do I know about the trade? I know it's going to be a long position. I know there's going to be one in May, as I showed you right over here. What happened to my mouse? Mouse, come back. And there's going to be one in August. Not 100% predictable, but I'm going to take you back to the model. Setup and trigger. So this is a setup. This is a setup. We have a 1 week setup over here. We have a 1 week setup to the downside over here. We have a 1 week setup to the downside over here. We will deal with all these. I'll show you how to grab these, but again, not perfectly. So what am I going to do? I'm going to go to a search mode and search the computer's brain for all the history and ask the question, is there anything I can do in August that has been highly predictable? And I can choose that by searching a database. Let me show you what I mean. One moment, please. When I go to the computer and I ask the question, show me for the month of August, is there anything that I could have done historically in the stock of H&R Block that would have been correct a high percentage of the time? And look what I found. I found H&R Block buying end of day August 6th, getting out end of day August 18th. Just a 12-day trade would have been correct 84% of the time or more. It shows me my average profit, my average loss, my average percent profit, my average percent loss, maximum consecutive wins, everything I need to know, including the entire history, with one exception. It won't tell me whether it's going to work this year, but my odds are dramatic. Considering the fact that most individuals are happy with 66% success rate, 84% is unheard of. The question is always going to be, but will it happen again this time? So here's the trade as selected from seasonality with the statistics, including the risk, the stop 3% close only. And we want to know what happened. Let me show you a chart. And by the way, this was all picked ahead of time, which is what we do with seasonality. Here is the performance history of this chart going back at least, I think, 35 or 40 years. So here it is, year by year. And you will notice these lines over here below the center line are losing years. These are winning years. You'll notice an interesting feature. Every year that this trade has been on the negative side, it has made money the next year. It has never had 2 consecutive losses in a row, 2 consecutive losses. But furthermore, what's really amazing is, in the last 2 years, it has turned in its 2 best years ever. The reason I point that out to you is people say, well, seasonality, everybody knows seasonals because everybody knows that it's not going to work. The bottom line is, we knew this before it happened. And here's what actually happened. Let me show you. Oh, one more thing. People will look at this cumulative performance and they'll say, well, it's been working too well, so it's time to not do it or to actually go short. The answer is all in the statistics. It's not in the opinion. It's not in whether there's geopolitical crisis. It's not whether there's a fire. It's not whether there's a war in the Middle East or with Russia. It's not in that. It's all about the pattern. So here is the actual chart of what happened this year to a trade that we knew in advance based on seasonals. This was the entry date right over here. This was where the trade stood at when it reached its first profit target. Because the printout not only tells us what to do and when to do it, it also tells us the first profit target. But here is the completed trade from start to finish. Truly dramatic. Entry date, exit date, right over here. All completely known ahead of time. Now, this is an outsized example, by which I mean it's not going to be like this every time, but the combination of what we're doing, which is seasonality as a setup, timing as a trigger, is indisputable. It's a specific methodology that will not work all the time, but will work strongly enough for you to get you out of danger quickly by hitting the first profit target and then letting you trail the stop and so forth if you're a trader. Let's go forward and look at a few more things that you might find interesting. So, what about coffee? What if I search for coffee futures and ask the question, is there any trade in coffee that's seasonally reliable? The first thing I want to do is look at the chart, the seasonal chart. And what does the chart tell me? Again, it's not rocket science. It's very similar to the one we just looked at before, except this is on the downside. So as you can see, the seasonal not only tells us the direction of the move, but it also tells us the magnitude of the move. So for me, this is a short trade. But remember, within the scheme of things, setup, trigger, and follow through, what is this? It's a setup which requires a trigger. So what would I do with this pragmatically? I will go to my coffee futures chart if I'm a futures trader, of course, and I will start looking for sell triggers to get me short this market so that I can participate in this move right over here, which is a high probability move to the downside. If the trade is profitable, I can sit through another 2 weeks and take advantage of this move right over here. So this is not only in terms of magnitude a big move down, but it is also a high probability move, which I said before, it requires a trigger. And what do I mean by a trigger? Example, divergence is a trigger. Moving average channel is a trigger. Moving average crossovers is a trigger. ADX, RSI, these are all used as triggers. And of course, depending on how you use those triggers and how you understand them, they will either help you or hurt you. So it's important also to do trigger research. What triggers work and what triggers don't work. Obviously, you don't want to use triggers that don't work. Combine them with the bad method of selection as a setup. Okay, let's take another look. A moment, please. Next slide. How about this one? September coffee again. And by the way, this is what the chart looked like over here in 2018. 6 years later, it still looked like that. Why do I point that out to you? It shows the consistency of cycles, that what was a negative period of time back then is still a negative period of time now. And in some cases, the negativity increases its percentage accuracy, as it did right over here with 76%. Let's go to the next slide. And by the way, this is what one of those trades looks like right over here. Entry date, right over here. Exit date, right over here. And you notice how quickly they turn around. Was in an uptrend, turns lower on the seasonal. Was in a downtrend, turns higher when the seasonal is over. I'm going to show you many more of these in future sessions so that you don't have to do the legwork yourself. So again, since I've been trying to indoctrinate you on the methodology, I want you to look at this chart. A mundane stock, a good one this year and many years, Alcoa. Not a high-tech stock, just a very basic industrial type stock. I'm looking at the chart, and I want to train you I want to teach you how my brain looks at these things. Not that you want to be in my brain. If you were there, you probably wouldn't like it. But I want to teach you how my eye looks at this and how I understand this. I see two moves of significance on this chart. And remember, this is a composite chart. We've taken every year of Alcoa stock from 1970 to 2024. As I've said before, who in this business wants to look at all the data? Most people don't. And the reason they don't is because the farther back they look on the data, the less reliable their indicator becomes. In our case, the more history, the better. So what does it say? I see two moves on this chart that pique my interest. Move number one, this 2-week period right over here to the downside. And by the way, I won't leave you flat, by which I mean I'm not going to present you with a bunch of ideas and never come back and revisit them. The ideas that I'm showing you here are just the beginning, because you ain't seen nothing yet. So I see this down move right over here. The magnitude is rather small, but the probabilities should be high. And if I go to a closer up search, a more manageable search by which I look at actual dates, I can find the entry and the exit dates here as well as the risk. But the thing that interests me more than anything else is this right over here, at the end of the chart. From the period of time, the second week of November, until the end of the year, the move in Alcoa encompasses the entire range of the chart from high to low. Meaning what? Meaning this is an explosive move up. Size-wise, it's a big move. Percentage-wise, it's a high probability move. But most important of all, it's going to be a big move if it happens. When I say that, I don't mean guarantee. I never mean that, but it does mean the probability is very high. And remember the paradigm, the model that I set for you. And by the way, if there's nothing you learned from me other than setup, trigger, and follow through, you will have learned a lot, and certainly the price was right. So I can expect a big move up in Alcoa toward the end of the year. And remember, it's only September. We still have several weeks now to go before we get this move. Now, what's going to happen? What's going to happen is most people will say, it's not going to happen this year. It's not going to be a big move this year because of this and because of that. There will always be an excuse. For me, there are no excuses. The only reason I will not take this trade is if I can't afford the risk. And if I can't afford the risk, I will simply trade a smaller position, or I'll find an option or an option strategy. So let's go to the next slide. One moment, please. Here we go. And here's a chart. What I've done is I've taken this period of time right over here, November, and I've put it on the chart on the screen, and I've asked the computer a question. Show me all trades that begin in November and end toward the end of the year or the beginning of next year that have been accurate or correct more than 75% of the time. Computer sorts these and finds these and gives me this trade right over here. It says buying November the 27th, end of day, with an exit January the 5th, with a stop risk close only of 12%, would have been right 83% of the time, and it gives me all the relevant statistics, percentage of time up, percentage of time down, and it will also give me the history and the seasonality so that I will know exactly where I stand. Now I want to put this in context for you. Very few people in this business, especially individual traders, the public, have the ability to do this, not because the information is not there, it's all available, but because they don't have the discipline to look at history and say, the numbers are what they are. I'm not going to argue with the numbers. And by the way, here are the numbers. In that trade I just showed you, seasonality, we're looking at 54 years, half a century. Every single year, win, lose, or draw. And this is what it looks like in terms of cumulative results. So, you can have excuses or you can have numbers. If you have numbers, you've got data. If you've got data, you've got methodology. If you have methodology, you have history. If you have history, you have probability. If you have probability, use that probability to your advantage and take these trades as they come. Again, minimizing the risk by position size or using an option as a strategy to take care of stops that might be too big. I'll be showing more about setup, trigger, follow through in future sessions, but remember, please support this show so that the people at the foundation will have me back again, because I love doing this, even though I'm not getting paid for it. Let's go to the next slide. Setup, trigger, follow through, which we've talked about. And again, setup, trigger, follow through. And let me talk about one more thing before we run out of time. One of the best books ever written on seasonality is called The Behavior of Prices on Wall Street by Art Merrill. Merrill examined the behavior of the Dow Jones Industrial Average before every major U.S. legal holiday. And he found that on the day before major legal U.S. holidays, so as an example, the trade that just had Good Friday, the trade would be to buy the end of the day on Wednesday. On Wednesday. Get out on the close of trading Thursday. Really, really simple. But I also noticed in my research that sometimes these moves begin before the actual date. So to show you what I'm talking about, here's a calendar of all the legal holidays. We did not do the trade on Martin Luther King's birthday because there's not sufficient history. We did not do the Juneteenth trade again because there's not sufficient history. But however, check the Monday, January 15th trade. The Wednesday, June 19th trade. Let me start again. The New Year's Day trade, the Washington's birthday trade, the Memorial Day trade, the Independence Day trade, and most recently the Labor Day trade all worked extremely well. Let me show you what I mean. Here we go. This is the Labor Day trade right over here. So the holiday was Monday, September the 2nd. The entry was to buy Thursday's close, exit Friday's close, and we could search for earlier trades. This is what happened right over here. Current chart. This was the holiday right over here, Labor Day. This was the Friday. This was the Thursday. This chart is S&P futures, showing buy on close Thursday, exit on close Friday. That was the same pattern in the NASDAQ mini. Here's the holiday right over here. Buy on the close here, get out on the close here. And again, you notice it's a one-night stand. It's an overnight trade. And let's go to the next slide. Same pattern. It also happened on the IWM. So we have a trade coming up on Thanksgiving. So what we're going to do is this. We're going to buy on the close of trading the day before. Last year, the day was the 23rd of November, was a Thursday. So we bought Tuesday's close, got out on Wednesday's close. I'm going to leave you with this thought. Tell me what we will be doing this coming November, and I'll give you the answer next time we meet. So let's look at one more thing and then you'll be rid of me for a week. Here we go. There was a trade earlier than the Labor Day trade, and that was found by computer again, showing you right over here, one moment please, that we could have entered on August the 20th and got out on September the 6th, a longer term trade designed to give us more profit, but because we have the data, we took a look at the data in detail, and here's what we found. Taking that trade earlier than Labor Day meant we would be in a trade that has had some significant losses. Notice, the losing years were much bigger than the winning years. So when it lost money, it lost big money. When it made money, it made small money. Therefore, we opted not to take this trade earlier, but rather to take the actual trade, which was the Thursday, Friday trade. Getting out on the close, getting in on the close Thursday, getting out on the close Friday. So here's that trade again. And let me show you one more thing before we're done. Next session, we're going to look at copper. This is the long-term history of seasonality in copper prices from 1890 to 2017. Not only do we use these charts for specific setups, but be aware of the fact that most people don't even have access to these. Oh, they're totally simple to get, and all the data is out there. All you need to do is write a little program to get this data. Very, very simple. Let me show you one more thing and then you'll be rid of me. Normalized price. If you take that copper chart and you split it into segments, a chart that shows the 10-year pattern, the 25-year pattern, the 50-year pattern, the 75-year pattern, 100-year pattern, and the 118-plus-year pattern, this is a family of curves. What does it mean? It means that no matter what time frame you look at, the tendency is the same. Copper prices bottom in September, October, which is exactly what they're doing this year, then begin to turn higher, reach their peak in May and June. I will show you more about this in the next session. I hope you can attend. You can also make a number of other. Let me show you one more thing. Here we go. Yes. Some stocks show these very significant moves. Example, here's a stock that I will be trading, 3M, beginning in mid-October, and it shows this incredible run of 1, 2, 3, 4, 5 weeks in a row of higher prices with high probability. I will show you how to find these and how to use these. So if you do have questions, please don't hesitate to drop me a line. My email address is rulesbasedtrader, that's rulesbasedtradr@gmail.com, and I look forward to seeing you again next week if the good people at Foundation will let me do this again.